the title of it is Reinventing Markets, but given our panelists, it's really about financial markets. And let me just start. I made Doyne Farmer is farthest to my left, and because his bio in the book doesn't really tell all this, I'm going to give him a slightly longer intro. He's a professor at the Santa Fe Institute, but what you need to know is around when he was getting his PhD in physics, he was sort of one of the early explorers of chaos theory. Then he had a very successful brief career as a roulette player. Sometime after that, he had an even more successful career as a hedge fund manager. And now he's trying to reinvent academic finance, the academic study of finance, with mixed success, as he will probably tell you. Duncan Niederauer is CEO of an organization called NYSE Euronext, which that has something to do with financial markets, right? A little something. OK. And before that, he had a long and illustrious career at the Goldman Sachs and Company. You went to NYSE in 2007. That's right. He's now the CEO. And he let me ring the bell last week, the closing bell, so I am utterly compromised as a moderator, whatever. And Barry Silbert, after a long and illustrious career, he started at age 12 as an investment banker at Houlihan Lokey and elsewhere, started, I guess, about 6 years ago, 5 or 6 years ago, an organization called SecondMarket. And I will at some point give you like 15 seconds to do your explanation and advertisement, but it's this really rapidly become this shockingly large market for assets that aren't quite ready for the prime time of public markets, like, say, Facebook shares. So I definitely want to involve all of you as much as possible, and we will move to questions from the audience pretty quickly. But if somebody's saying just motivates you to go, ooh, 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 go ahead and do it, and I will try to keep my eyes open, although the lights make it a little hard to see all of you. But the first question I've got, and this one I'm just going to ask all three of the panelists, is simply, tell me something that's wrong about financial markets as they exist today. And I'm going to start with Barry.
OK.
This is going to be quick.
Yes, I'll try to keep it quick. So I think big picture, trust has been destroyed throughout our entire financial system. I think there's zero innovation going on in our financial system except for creating new products, but specific to the public markets. I think I would argue that the public markets are broken for companies below a certain size. And even companies of a certain size, there's, I think, some issues that exist that make them not want to go public anymore.
OK. Doyne?
Well, I think the problem with markets is that we don't understand them. I think what the crisis has taught us is that markets are like gardens. They need tending. And we can't, it's not good enough to just start an exchange and let people trade. You have to understand what the right rules are, how much leverage should people be allowed to use, when can they use more, when can they use less, how do you understand when a market's about to fail, and how do you intervene and recover when it is about to fail. And I think the crisis taught us a humility lesson that we really don't understand these questions. We don't know when we can use complex systems analysis to try and understand what's really going on and how to deal with it.
Yeah. Duncan.
And I think a lot of the innovation that went on in the markets in the last couple of years was actually in the unregulated parts of the markets. So the challenge we end up with, if we think we learned anything in the crisis, it was mostly unregulated banks and the shadow banking system that created the problem. Yet I think Barry's right. The regulated markets haven't exactly provided a solution for small companies either. We've spent a lot of time in the time I've had this job with the venture community and the private equity community talking about how we try to fix what's broken. And I think it's going to require a private enterprise solution because, as we were discussing before we came on to the stage, there's no question that Congress has overregulated in reaction to things like Enron with Sarbanes-Oxley. I think the cost of being a public company has just been allowed to run amok in this country. And I think as a result, a lot of smaller companies who we actually should be facilitating their access to capital and the capital formation process, whether the government meant to do it or not, we've inadvertently done just the opposite. And I think it's incumbent on all of us to figure out creative solutions for dialing that back and making sure that those smaller companies can get access to the public markets, because the statistics are pretty compelling. Once they do, the job creation engine looks like a hockey stick after that.
So do you mean that all the solutions are not in the 2,300 page financial reg reform bill?
Yeah.
That's shocking.
Yeah, I know, exactly. And there's almost, I think the 4 words that are missing from the 2,300 pages are the words Fannie Mae and Freddie Mac. You're not going to find them in there, but there is nothing. The closest we got to what Barry's talking about, to even the hint of a step in the right direction towards making it easier, was to raise the exemption, the market cap exemption for companies to not have to comply with Sarbanes-Oxley. We were pushing for that to be increased from 75 million to 500 million. You know, guess who shut that one down? The Big Four lobby. So I think we're going to have to keep working on that.
Well, I guess I'd like to defend the financial reform bill a little bit by.
Well, and I just want to say, actually, the final version was 848 pages because they used really small type. But go on.
Well, and so the 20 pages that were in there on the Office of Financial Research is probably now at about 8.
What's the Office of Financial?
The Office of Financial Research is the sleeper provision in the bill that creates a new agency that will be like the National Weather Service that will tax financial institutions and require them to report all their transactions in real time so that we actually have a map of the financial landscape and can have some idea what's going on if we have another crisis. Because in this crisis, we had no idea what was going on as the crisis was unfolding. We had no idea how to recover. And when the crisis happened, one of the reasons Congress didn't know what to do is because nobody could tell them what they should do. Right. Nobody had a clue how we ought to reform the financial. Everybody had ideas, but nobody actually could demonstrate that their ideas were the right thing to do.
So is that Office of Financial Research then going to provide the consolidated and interpreted data to the Systemic Risk Council?
They are.
Also been proposed?
The Office of Financial Research will be independent of the Treasury. The director will be appointed by the president, and they'll testify to the council and give them they'll have a risk dashboard that will essentially provide the information that council needs to make intelligent decisions.
Right, and I think those are all steps in the right direction. I think what we're saying a bit tongue-in-cheek is it's hard to imagine that took several hundred pages of small type to cover this. There's a lot of stuff in there that frankly had nothing to do with the crisis, right?
Yeah, and this actually came out of left field. The Office of Financial Research was
who got it
an
in
independent group, a guy named John Lichty, who was a professor at Penn State, who was doing consulting for Morgan Stanley, said, hey, you mean we're having a crisis and nobody has any idea what's going on? Maybe we actually need some information. He got Dodd to put this stuff in the bill, and it just kind of slipped through without any real discussion by Congress or anybody else.
Well, I think a lot of people in the audience probably saw that the accredited investor definition, there was a proposal, there was a draft where it was going to be increased to 3 million, 4 million in assets and $500,000 in income. And you go down to DC and you talk to people in Congress, why is this? And no one knows why. No one seems to have been complaining, and it was thanks to the MVCA and the Angel Capital Association to kind of keep that threshold down. So Congress doesn't seem to understand certainly the importance of venture, angel, doesn't understand the problems that exist in the public markets that needs to be addressed relating to the private companies. And
but Barry, I want to dial back, because at least in the discussions I've had with you before, you think the problems predated Sarbanes-Oxley.
Absolutely, absolutely.
What is it about public markets that made them less receptive to startups, to IPOs?
It started about 10 or 11 years ago with the advent of online brokers, where basically you democratized investing, where there was no longer a broker pushing stocks. Then you had decimalization, so the money, the spread that was being made to make markets, to provide research, was taken out. You had Reg ATS, you have all these new marketplaces being formed, so it's kind of fracturing the market. And then you have things like the Sarbanes-Oxley was kind of a nail in the coffin, and then you had
because all those things before Sarbanes-Oxley, those sounds like things that would make markets more efficient and more transparent.
But if you think about how stocks get bought and sold, I mean, there's a saying, stocks get sold, not bought. And again, 10, 11, 12 years ago, you had a broker, and your broker said, hey, I know this great company, you should buy this stock. Now, I mean, retail investors, they're kind of plowing into day trading and kind of volatile names. They're buying the Googles and the Apples of the world, but they're also putting much of their money into ETFs and other types of products like that. So now you see...
So those dinosaur brokers were actually doing something useful?
I think a large percentage of them were. But now, today, 75% of trading in the public markets is high-frequency program trading. And 10 years ago, it was 20% or less. That's a scary statistic. The average holding time has gone from, I don't know, 1970 it was 5 years, now it's well less than a year.
Yeah, and I think part of this, folks, is what all these regulations have added up to the last 15 years, and just changes that a lot of which were enabled by technology, right? We all could have predicted, those of us who studied the markets, in 2000, once you had the advent of decimalization that you were just referring to, and some other changes on the back of that, technologically enabled market making was not far behind, right? And I think you'll hear the stat that Barry just quoted, could be 50%, could be 60%, could be 75%. Some of the definitions are kind of loose of what's technologically enabled trading, but I think there's no question that over time, whether the regulators meant to or not, we've turned what was very much an investing market into a trading market. And I think the challenge we've got for the small companies is the research issue I don't worry as much about, because having been in touch with the small and mid-cap portfolio managers my whole career in the business, they do their own research anyway. I think they started to devalue sell-side research a while ago. But that trading business where you need to incent people to make a consistent market in your stock, to have liquidity in the market after you do your IPO, I think that's got increasingly more challenging. And that's one of the reasons why the model we run, as outdated as everyone tries to tell us it is sometime, a core principle of the markets we run is there is at least one, if not more counterparties who has a responsibility to make a market in the stock that they're trafficking in at all times. We pay them out of our own results to do that. It's not close to the solution, but at least it's a step in the right direction, because Barry's right, with decimalization, the spread opportunity, the spread capture went way down. It's gotten a lot harder for people to provide that consistent liquidity and have that be an economically viable.
Is that the guys who are still on the floor, or doesn't have to be that?
Most of it's done virtually. I think our view is that we've invested more in technology than any other exchange globally. It's a big part of where we're going as a company. At the same time, I think days like May 6th teach us that, and the crisis taught us that it's not so bad to take the plane off autopilot once in a while and have the ability to do that. I don't think, as technologically enabled as the markets have become, I think there's still a place at an appropriate time, in times of turbulence. Sometimes it's momentary, sometimes it's elongated. I like having the idea that you can actually slow it down and discover the right price, which we owe to issuers and investors. And everyone seems to be worried about the traders. That's great. They're an important constituency. We try to worry about issuers and investors too.
I'm going to go to questions in just a second, but I have this softball in mind that I just have to pitch at Doyne, and then we'll go to you guys. Standard finance theory that's been taught for the past 40 years would say that you have more transparency, you have more efficiency, you have go to decimalization from fractions, that's just going to get you a better market, a more efficient market that's going to calmly price things perfectly all the time. Why isn't that happening?
Well, I just think it's a totally naive view about what a market is and what it does. And we see that not only do we have behavioral phenomena, people are not rational, and you can't count on that playing out. There's a lot of studies now that have shown as soon as you have some irrationality, it's not sufficient to have complete markets. In fact, complete markets can actually have more problems than incomplete markets. And on top of that, markets are complex systems. You've got a lot of different players. You've got a complicated ecology. That ecology is changing all the time. There are nonlinear feedbacks built into it. When you start doing something like leverage, you end up having people be forced to sell into falling markets because bank risk regulations require them to do that. So you get these collective systemic risk phenomena where the very thing that you're trying to do to keep the market functioning right, naively, having banks recall loans when the loans are overextended, actually causes markets to collapse. And so until we understand those kind of things, until we know how to tinker with the rules, like when should margin calls be made, how should the payments be done, until we understand those kind of questions, we're going to have tons of problems. And we're always going to have problems because financial markets are complex systems and we can't expect them to just evolve automatically and perfectly.